Whether consciously or not, every investor in stocks wants to know when they can expect to double their money. And the only way that you can truly answer that question is to have a very clear understanding and knowledge of the power of compounding. It's alleged that Albert Einstein once said that this was the most powerful force in the universe. And when it comes to investing, it's really critical that we understand the power of compounding. So to do that, I'd like to introduce the rule of 72. It's a very simple little rule, and it says you divide any rate of return into the number 72, and it tells you how many years it takes earnings or money to double depending on what you're doing. Okay, so to follow that up, if you earn 10% per year on your money, you should have rationally expected to take approximately 7 to 8 years, 7.2 years for your money to double. If you were earning 20% of your money, it would take 3.6 years. And if you were looking at, let's say, a normal working life of around 36 years, this is a number that's picked to make the math work, then if your money doubled every 7.2 years and you divide 7.2 into 36, you would double your money 5 times. If you earned 20% and your money doubled in 3.6 years, you would have the opportunity to double your money 10 times in 36 years. And there is this idea of compressing time is where the real power of compounding comes into play, but time is the critical factor here. So, let's follow the money there and let's just kind of crystallize that. So just hypothetically and metaphorically here, if you invest $1 and earn 10% on that dollar every year for 36 years, which obviously wouldn't happen, then that dollar would double every 7.2 years. That means that at a 10% rate of return, your money would double from 1 to 2, 4, 8, 16, 32 times. That's 5 doubles in this 36-year period. However, if you doubled your rate of return and earned 20%, what you get is double the doubles. Instead of 5 doubles, you would get 10. So your dollar would go 2, 4, 8, 16, 32, $64, $128, $256, $512, and you would end up with $1,024, or 32 times more money by earning 10% instead of 20%. So when it comes right down to it, compressing time is all about double the doubles, not doubling the money. It's really about cutting in half the amount of time it takes. So if you look at a simple compounding table, let's assume you had a stock like a utility stock, and I'm going to show an example of Southern Company here a little bit later, and you're in, 5% or less. I don't even have a doubling of earnings. That's the earnings per share. If you look at $1 and you grew it at 5%, it would take 20 years. I only got 10 on the graph here. If I earned that 10%, it would take every 7.2 years, and you can see at 7 years, a dollar would grow to $1.95, and you had 0.2 years and you get to $2. And then at the 20% number I talked about, your money doubles about every 3.6 years. So you can see 1, 2, 3, and then about halfway through, you get to $2.07. All right, so, the difference between 10% is $2.59 over a 10-year period versus $6.19. At 30%, it would be the difference between $6.15 and $13. So this idea of compounding money at various growth rates is critically important. Now, why do I bring all this up? I've been doing videos here, and I get a lot of, criticism from subscribers. But before I do that, let me go ahead and introduce myself. My name is Chuck Carnevale. I'm co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known as Mr. Valuation. And I produce these videos quite often, and I'm always trying to help investors understand the investing process better and recognize, what it is that they're investing in if they're buying stocks. And I try to cover individual stocks, but I also like to talk about investing principles. So in today's video, I'm going to share 3 stocks here that basically corroborate the power of compounding presentation that I just did for you. Because what happens is I've had investors kind of be critical of a couple of stocks that I produced a year ago or less in other cases. And those stocks haven't made the money or haven't doubled in value yet. And it really comes down to understanding, whether you are a day trader or a swing trader, which I think is an exercise in folly in the long run. You can win sometimes, but you can also lose more often than you win. It's like gambling of any other kind. The nature of gambling is the odds are stacked in favor of the house, not you. Now, but if you're an investor, that implies being a long-term holder. And it's critical to understand that it takes time for companies to generate the ability to increase your wealth, to double your money, in fact. And that's why I think it's important to understand this power of compounding concept, because if you're investing in investments, you should understand what you're investing in and what they're capable of giving you. So I'm going to use some examples here, 3 examples. I'm going to use a slow growth utility stock, Southern Company. I'm also going to use a faster growing stock, Philip Morris, or Altria, actually, not Philip Morris, Altria. And then I'm going to finally end up with a real powerful growth stock that, all of you know as Google. It's now currently called Alphabet, but we'll call it Google. So what I want to do is illustrate the reality of the power of compounding that I talked about in the beginning of this video. So let's go ahead and go to the fast graph tool now, and let's look at Southern Company starting out. I want you to notice that I've got a 20-year time frame, and that includes, some estimate years here as far as calculating this growth rate. But this company's been growing at 3.61%. Now that's less than, the 5% I talked about. So if you divided 3.61% into 72, you would get 19.9, or approximately 20 years to double the earnings growth of this company. Okay. And therefore, if you buy it at value, one of the principles I've always stated about buying at value is that it allows you to fully participate in the growth of the company, whatever it is. But when you invest in a utility stock like Southern Company, you're not investing to double your money every so many years. You're investing to earn the income that utility stocks are notorious for throwing off. Even at the high valuation that Southern Company currently trades at, it's yielding 4.47%. So if I use my dividend yield column here and I go back to what it was here in the beginning of these things, I can see that I was getting 4% yields on this stock. Now, they increased their dividend every single year. And I look at the 20-year period here with a 3.61% growth rate. I check my performance, and I find out that the company increased their dividend by about 3.69%. That's almost perfectly in sync with the earnings growth rate that the company generated. Now, valuation is going to have an effect on the rate of return you earn. But what I want you to focus on is the reality of how long it takes companies to grow their business if they have characteristics of certain types of growth rates. And a utility like Southern Company is a very slow grower. And even they're forecasting in the future, they're expected to grow at 6 or 7%. But, historically, they've been a 3 to 5% grower. Okay, so if I look at this company and I see what they earned in 2005, Southern Company earned $2.14. So I'm looking for $4.28. Where am I going to find that? I run my eye along here and I go all the way out here, and 20 years later I'm at 4.15, which is slightly less than the 28. But I also want you to notice something about growth. Even though it averaged 3.61%, the growth rate itself is less consistent than that. They grew at 5% one year, -2, 5, 7, -2, 2%, 8%, 4%, and so on and so forth. But the point is it averaged 3.61%, and it's uncanny how that average gave you. So if you invest in a utility like Southern Company, and even if you buy it at an attractive valuation, okay, you can't expect to double your money, even if you get lucky and get into overvaluation, anything short of a long period of time, 10, 15, 20 years, frankly, is what you should be expecting. Now, by buying it undervalued here, you accelerate that time frame a little bit because you're getting the leverage of buying it below its intrinsic value. But otherwise, the growth of the business is what makes the money. Now, to make this all make sense to you, I think you have to also embrace the principle that in the long run, earnings determine market price, or the operating results of the business determine where the price is going to go. And you can clearly see that Southern Company follows its earnings growth and hovers around a 15 to on the high side of 16 or 17 PE. But clearly, because of the low growth characteristics of this stock, you'd want to buy it when it was undervalued. When you had a true margin of safety, it would not be an attractive buy today. But I wanted to use this because it's a quintessential example of a slower growing stock. So let's move on now. And I've picked companies that had consistent earnings growth, because if you get cyclicality in here, it kind of messes up the mathematics, because it's the concept, the investing principle that I want you to basically focus on and understand here. So, being a long-term investor is about understanding what characteristics of the stocks you're investing in, understanding what they can give you, and also recognizing and knowing yourself, recognizing the investment, characteristics that the stock possesses and what that can deliver to you as an investor. Now, you look at a stock like Altria, Philip Morris, over this 20-year period, they grew at about 8.3%. So that means their $1 of earnings would double about every 8.5 or 9 years or so. So I go here and I start 2005, roughly, 20 years ago, and I got $1.18. So I'd be looking for $2.36. All right, so it takes me 1, 2, 3, 4, 5, 6, 7. I'm in my 8th year now, and it's about 8.3, and I'm getting my $2.36, which is double the $1.18 that I started out with. But it took 7 or 8 years for that to occur. And by the way, if I looked at the stock price here and measured that, the $14 stock price, and came out here to the end here where I had the 238, that's where I get the $37 stock price or the $35 stock price, which is just, something approaching double the money. It took that many years to double my money. Now, in the meantime, there's volatility in the stock price. There always is, always has been, and always will be. And sometimes stocks get disconnected and they get overvalued. But if you're a rational, prudent, long-term investor, you recognize that, forgetting about price action, that you've got to let the business grow over time to generate the value and the rate of return that the business is ultimately going to direct. Now, you come into, finally, just a powerhouse, a pure growth stock, no dividends. On these other graphs here, the white line is the dividend. The area below, it's the payout ratio. This is, again, a very high-yielding stock, Altria. And you can see they're paying out most of their earnings in dividends. But we're focusing on the power of compounding here and understanding how prices work in investing, and prices are going to follow the earnings. You can clearly see in Altria's case where the price followed the earnings, and when it gets disconnected, it comes back, and it's been disconnected again for several years. It was overvalued for several years. That's just the way the cookie crumbles, so to speak. And if I look at Google, they've grown at 29.85. We'll call that 30%. And roughly, if you divide the 29.85 into 72, it takes 2.4 years for this company to double its business earnings. So we're only talking about a couple years. So, but now look down at the bottom here. You've got growth rates that vary quite a bit with this company, but there's 13 cents. I'm looking for 26. It grew to 33 in just 2 years. Here's 33 cents. I'm looking for 66 cents. Again, it took just a couple of years for the 33 to turn into more than 60 cents. So I'm looking at 75. I'd be looking for $1.50. And you can see it took me about 3 or 4 years, but also notice that this was a period of lower growth rates. The moral of the story is the company's operating results are what generates the value for you as an investor, not the day-to-day fluctuations in the stock price. And there's always going to be fluctuation in the stock price. Now, why do I bring all this up today, and why am I talking about this so much? Well, first of all, I think it's critically important that investors understand how money works, how compounding works, and how stock prices work in relation to that. Ultimately, in the short run, emotions determine stock price. Stock prices can rise and fall according to the moods of the public that's investing in them. But in the long run, the rubber's going to meet the road based on the operating results that the company generates. So I was criticized on a couple of stocks here, and by the way, I'm not worried about the criticism. I really don't care about it. What I'm trying to do is make sure that those of you who are good, prudent, long-term value investors understand how investings work and what you can expect from your investments. So, a company I did, if you go back here in time, on January of this year, I looked at Comcast. Okay, and this is what Comcast looked like. The price was approximately $51 a year. I'm sorry for the blurriness of that particular.
Most importantly,
graph. This was a video I did back in January of 2022. So looking at the price here, it was below the orange line. I talked about it offering you a margin of safety. I felt this was a good time to be investing in Comcast if you were a long-term investor. This is a 17% grower. So again, we're looking at around 4 or 5 years before the company would be expected to double your earnings. Well, here's what Comcast looks like today. And that price that, I showed in the video was somewhere right around here. And the stock has drifted lower. And a lot of critics about, he recommended the stock, several months ago and it's down. Well, the point is, I'm not trying to focus on stock price. I'm focusing on the operating results of the business and the fact that I believe this business is capable of generating growth for shareholders for years to come. And it's going to take years, not weeks, not months, for the stock to generate. So I don't have a judgment necessarily on whether or not, Comcast is a bad investment or not. We see another period of time recently during COVID where the stock fell precipitously and then quickly recovered. And we see periods of overvaluation where it moved back into fair value. But in the long run, it tracks that orange line. And that orange line, the operating results of the company, is what I'm encouraging you to focus on and to worry about, because that's what matters. I still feel just as strongly, and I'm long Comcast, and I'm long inclined accounts with Comcast. I like this stock very much at these levels. I don't know how to pick the top or bottom. And if you think any guru is going to be able to always tell you what the bottom is, then I believe you're being very, very naive. I certainly know I'm not capable of doing that. But I believe Comcast was a good investment when I did the video, back in January. I think it's a better investment today. And I do believe you're going to see this company recover, but you need to be valuing what this decision was all about in maybe the next 3 to 5 years. Another one we did was 3M, and I covered 3M in March of 2022, again, just a few short months ago. Not long enough, and I showed that this was a stock that the market always liked to overvalue, that it was very highly valued, back in 2017 or 18 and so on, and then it got really overvalued in 19, 20, and 21, and now it was coming back into buying range. And here you'll notice the stock was trading at 149.47 the day that I produced the video. Well, this is what 3M looks like now. Now, there's about the $150 price, $149 and change that I was showing you in that time. You can see that the stock did drift and fell to $1.34, but now it's already recovered back to $1.41. So if I go back to the video was showing it at around $1.49. It is now at $1.41. Below what that price was originally, but yet the business is still doing well. And notice that the market likes to put a premium valuation on this stock. So there would still be significant upside, on this stock that potentially could be very, very attractive. In other words, you could be looking at over the next just couple of years earning a return of about 20% plus on your money every year. That my position on 3M has not changed at all. Just because the price is fluctuating around doesn't mean a thing. Now, sometimes there are different circumstances that happen in the short run. And by the way, 3M has raised their dividend for 64 consecutive years. Comcast, the first one I showed you, has raised their dividend every year for 15 years, but that's 100% of the time since they've been paying a dividend. These are dividend-producing stocks, and I was focusing on the dividend. That's why being a long-term investor matters. Now, I also, in April of this year, showed Stanley Black & Decker, and that was before their earnings came out. Now, this is where comprehensive research and due diligence comes into play. The company hit supply chain issues. There was a lot of political issues going on with, different parts of the world and so on, in currency conversions and so on. So the company actually reported a very abysmal year. Now, this company has increased their dividend for 55 consecutive years. It's considered a dividend king. Its earnings did fall, but the earnings fell during the Great Recession as well, and that turned out to be a great buying opportunity for this company. The stock price is down. It's currently trading at 93. When I first showed the video, it was at 144, but I didn't buy it to sell it. I bought it to hold it and collect the dividends, which is over 3.4% a year for years to come. And I won't be judging this stock, whether I made a good decision or not, for many years out here. But even if I look at it for what's currently expected on the stock, I could be making 16 or 17% a year from here, not from when I first recommended it. the historical growth rate of this company has averaged about 10%. So if this recovers back to that like it did coming out of the Great Recession of '08 and '09, this would be an awesome time to be buying Stanley Black & Decker because the company's still generating enough cash flow and enough operating results, and they have such an impeccable dividend record that none of that has really changed. So the moral of the story here is that, be a long-term investor. Anyway, this has been Chuck Carnevale. I hope you enjoyed this. I kind of wanted to cover some principles of investing here and try to remind everybody that it's not about focusing on the stock price. It's about doing your research and understanding the fundamentals of the business you own. And it's also with, for example, a company like Stanley Black & Decker is making a distinction between a temporary interruption and a permanent impairment of capital. I think Stanley Black & Decker is going to recover great. Companies like Morningstar, Zacks Investment Research, they're talking, about the company really has some, really great opportunities ahead of itself. And they all expect the earnings to recover. They expect the cash flows to recover. No one's expecting a dividend cut yet. The price is down. If you loved it when I first showed it to you, then you ought to love it more. If you enjoyed this video, ring the bell. Obviously subscribe to the channel. Give me a like. And, take a look at fast graphs. And by the way, when the earnings of Stanley Black & Decker came in real short, that was not a fault. You can see the analysts, if I'm looking at earnings forecasts for 2022, 6 months ago, the leading analysts following this stock thought the company was going to earn 12.22. Fast Graphs doesn't make those predictions. The outside analysts, the people, the professionals who are watching. And now, the earnings are coming in at, now expectations are for, less than half of that at $5.48. And those earnings projections continued to fall, as did projections for 2023 and 2024. But when I look at this company's scorecard over time, they've had an impeccable record. They've had a couple of bad forecasts during 2012 and 2013 when they were making estimates 1 year in advance. And their 2-year record is equally as good. So generally speaking, analysts get this company right. They didn't get it right 100% of the time because the only thing certain about the future is uncertainty. Anyway, I hope you enjoyed this video. Thanks for watching. I'm looking forward to talking to you guys again soon.